Welcome to the Deep Dive. Today we're looking at a real head-scratcher, AbCellera Biologics. It's a Canadian biotech firm, and its stock price is just absolutely cratered. We're talking down over 95% from its post-IPO high.
95%? Wow.
Yeah, 95%. You'd think that signals a company, on its last legs, right?
Typically, yes. That sounds dire.
But hold on, because they're apparently sitting on this war chest of cash. Their available liquidity is actually more than their entire market cap.
Okay, now that is interesting. Liquidity exceeding market cap.
Exactly. So is this the kind of disconnect that, value investors dream about? A chance to grab a potentially game-changing company for less than it seems to be worth?
Or the other side of the coin.
Or is it a classic falling knife? A stock that looks cheap but just has further to plummet.
That's the core tension, isn't it? Value trap or deep value?
That's the puzzle we're going to try and dissect today, really diving deep into the fundamentals using core value investing principles.
And it's a fascinating situation. AbCellera, founded back in 2012, a spin-out from the University of British Columbia. They built their name on this AI-powered antibody discovery platform.
Right.
Had some notable early success, especially, their rapid work on COVID-19 antibody therapies with Eli Lilly.
I remember that, yeah. Bamladi-Vab.
Exactly. But the biotech landscape is, well, it's always shifting, and AbCellera's strategy seems to be shifting right along with it.
Makes sense. So our mission in this deep dive is really to put on our value investor hats, you could say, and thoroughly analyze AbCellera.
Right.
We'll be digging into a whole range of sources, company reports, news articles, analyst opinions, that sort of thing. All the stuff you might review if you were looking at this yourself.
Kind of a streamlined research process for the listener.
Exactly. Think of it that way. We'll highlight what seems to really matter. We're going to start by getting a solid handle on their business, then look at the management team, followed by a detailed look at their financial health.
That's the first half.
Yep. Then in the second half, we'll gauge market sentiment, see who actually owns the stock, assess the critical risks involved.
Always important.
And then try to bring it all together with a final value investing perspective. Okay, so let's start by unpacking exactly what this business does.
Sounds good.
And just quickly, all the sources we're referencing today, they're listed down in the description for you.
Okay, so history and evolution. Context is really key here, I think.
Absolutely.
Founded 2012, UBC spun out, biomedical researchers involved, including the current CEO, Carl Hansen.
Right?
And he has a PhD in engineering physics, which, maybe suggests a certain analytical approach at the top.
Interesting background for a biotech CEO.
It is. Early validation came pretty quickly, a big partnership with Pfizer in 2014.
Okay.
Then a really pivotal moment, I think, was the DARPA P3 contract in 2018. That was focused on pandemic response.
So that laid the groundwork for the COVID stuff.
It seems like it paved the way, yeah. For their rapid work with Eli Lilly on bamlanivimab and bebtelovimab, got those emergency use authorizations.
Which were later revoked, though, right, as the virus changed?
Crucially, yes. They were revoked. Important context. Strategically, they also made some key acquisitions along the way.
Like Lineage Biosciences.
Yep. Lineage in 2017 for their RupSec technology, and then Triani, Inc. in 2020 for their human antibody platform, the Triani mouse.
Got it.
Then the IPO in 2020 raised a pretty hefty sum, $555.5 million.
Why?
And they've plowed money back into infrastructure, opening their GMP facility in 2022. That's good manufacturing practices.
Right, so they can actually make their own drug candidates for trials now.
Exactly. It's a crucial step, but often a very expensive one for a biotech. These steps really show a company building out a comprehensive system.
Okay, so that leads into their business model, which you mentioned is kind of shifting.
Yeah, it seems to be a real turning point. They started out mainly with this partnership model.
So providing their AI discovery platform as a service.
Pretty much. To big pharma, other biotechs. Revenue came from research fees, then milestone payments if a partner hit certain goals.
And the big one, royalties, if a drug actually got approved and sold.
Right. And as of March 31st, 2025, they had something like 97 partner-initiated programs still active.
97? That's quite a few shots on goal, potentially.
It is. Lots of potential downstream payments baked into those partnerships. That model, it provided early validation, fueled their initial growth.
But now they're changing tack.
Seems so. We're seeing this significant strategic shift towards developing their own internal pipeline of drug candidates.
Taking on more risk themselves, basically.
Exactly. They're investing heavily here, aiming to capture, a much larger slice of the pie if their own drugs work out.
Makes sense financially if they succeed.
If they succeed, yes. The focus is on what they think could be first-in-class or best-in-class therapies.
Like ABCL 635.
Yeah, ABCL 635 for vasomotor symptoms. That's potentially a first-in-class NK3R antagonist.
NK3R, involved in things like hot flashes.
Precisely. And then there's ABCL 575 for autoimmune diseases. That's an OX40L antagonist. These are their lead internal programs.
But as you said, higher risk. Clinical trials are tough.
Hugely risky. Milestone payments aren't guaranteed, like research fees. And it just takes massive amounts of capital to get through clinical development.
So they're not just a service provider anymore. They're playing the high-stakes drug development game now.
That sums it up well.
Which brings us to, well, what are they actually offering? It sounds like more than just standard lab work.
Oh, definitely. The core is this integrated, AI-powered antibody discovery engine.
Okay.
It's a whole suite of proprietary tech. Microfluidics, high-throughput imaging. The AI part is critical. Using machine learning to sift through mountains of data, find promising candidates, even predict properties.
And the genomics?
Yeah.
From the lineage acquisition?
Yep, high-throughput sequencing. Plus, the antibody sources themselves, their own protocols, and that Triani mouse they bought, which makes fully human antibodies.
So it's a pretty comprehensive toolkit.
It seems so. They're tackling tough targets, too, like GPCRs, ion channels, and moving into T-cell engagers, TCEs.
Right, that collaboration with AbbVie you mentioned.
Yeah, that's on TCEs. What's really interesting, I think, is this full stack idea, the end-to-end integration.
Meaning they do everything in-house?
Largely, yeah. Lots of competitors might focus on one piece of the puzzle, but AbCellera seems to have deliberately built this comprehensive platform.
The idea being speed and better results.
Basically. Speed, exploring more possibilities, and hopefully finding superior drug candidates. The COVID response, despite the EUA revocations later, was kind of their real-world proof of concept for that speed,
Okay, makes sense. So looking ahead to this year, 2025, what are the main priorities? Sounds like doubling down on that internal pipeline.
Absolutely seems that way. The big goals for the second half of this year: get those phase 1 trials started for ABCL 635 and ABCL 575.
Good.
They also want to nominate more internal candidates, so really building out that proprietary portfolio.
And finishing the big infrastructure projects.
Yeah, finalizing the platform and facility investments. That GMP manufacturing facility should be fully online in the first half of 2025.
And less focus on new partnerships.
It appears so. Reducing new broad discovery deals, focusing more on existing ones, and strategic collaborations like the TCE work.
So a really clear pivot towards becoming a drug development company first and foremost.
It looks like a very deliberate, high-risk, potentially high-reward shift. And you really see the financial impact of this when you look at their revenue breakdown.
Okay, table 2 in the sources.
Yeah. The change is just stark. Back in 2021, 2022, it was all about those COVID royalties. Huge revenue.
Right.
Fast forward to Q1 2025, almost nothing from royalties. Revenue was just $4.2 million, nearly all from research fees.
Wow, that's dramatic. So the challenge is replacing that lost income.
Exactly. How do you replace that high-margin royalty stream? Their future really hinges now on generating those milestone payments from existing partners, and crucially, hitting home runs with their own internal drugs.
Okay, that historical context is vital for understanding where they are now.
Definitely.
All right, solid picture of the business and the strategy. Let's pivot to the people running the show. Your management team.
Right. Led by CEO Carl Hansen, co-founder, still there since 2012. Also the chairperson.
Long tenure. And we mentioned his significant ownership stake, which we'll get back to. Suggests alignment, maybe.
You'd think so. Other key long-termers. Co-founder Dr. Veronique Lecault is CTO. Andrew Booth is CFO. Also an engineering physics background from UBC, interestingly.
And Trin Steinmart is chief legal officer.
Yep. The broader management team tenure is shorter, maybe 2.3 years on average. But the board's been around longer, 5.7 years average.
And what about their track record? What have they actually achieved?
Well, they've taken it from that university spin-out to a public company, built the platform, landed key partners like Pfizer, Lilly, AbbVie.
Managed the whole COVID response.
Right, immense pressure there. Did the IPO, made those strategic acquisitions, Triani, Lineage, expanded facilities, and importantly, they've maintained a strong balance sheet through all this.
That last point seems critical now, given the cash burn
Absolutely.
and alignment of interest, Hansen's ownership, somewhere around 19 to 21% through Thermopylae Holdings. That's a big chunk.
It's substantial. His fortunes are definitely tied to the company's long-term success. Plus, you mentioned recent insider buying.
Yeah, Thermopylae and director John Montalbano bought shares back in March 2025.
Which can be seen as a positive signal, insiders putting more skin in the game when the price is low.
So what about governance? How is the company structured from an oversight perspective?
Okay, governance. As of April 2025, they had a 5-member classified board, staggered 3-year terms, pretty standard stuff.
How many are independent?
3 of the 5 are independent directors. Now, Hansen holds both CEO and chair roles, which sometimes raises eyebrows, but they do have a lead independent director, Dr. Michael Hayden, specifically for independent oversight.
Okay, that helps.
And they have the standard committees, audit, compensation, nominating, governance, all independent directors' formal charters. The audit committee chair, Montalbano, is a financial expert.
Yeah.
They also have a majority voting policy for directors. So overall, the governance structure looks, pretty much in line with typical practice for a company this size.
Seems reasonable. Okay, so how are these executives getting paid? That's always a key area.
Right. Executive compensation, it's the usual mix.
Right.
Base salary, potential cash bonus, and then especially in biotech, significant stock option awards.
And those numbers for 2024 were pretty big.
They were quite substantial, yeah. CEO Hansen's total comp was $8.25 million, but the vast majority of that, like $7.5 million, was from option awards.
Okay, and the others?
The other top execs, Booth, Lacoste, Steidermart, were in the $2.8 to $3.4 million range, also heavily weighted towards options. Base salaries were all $460,000.
So how should a value investor view that, especially with the stock price where it is and the company losing money?
That's exactly where the scrutiny comes in. Using options is normal to incentivize long-term performance, particularly in R&D-heavy sectors.
But the size of the awards.
Exactly. The magnitude, especially relative to current performance and market cap, could raise questions. Hansen's 2024 pay was like double the average for similar U.S. company CEOs.
So the key is whether those options are truly tied to creating long-term value.
Precisely. Are the goals clear, ambitious, achievable, and actually aligned with shareholder interests? We'd need to see the full details in the proxy statement, the vesting schedules, performance metrics.
And shareholders get a say eventually.
Yep, there's the say on pay vote, so an opportunity for feedback there.
Right. Okay, related to that is capital allocation. How are they deciding where to spend their money? This seems absolutely critical right now.
Couldn't agree more. Their stated priorities seem clear, though. First and foremost, investing in that internal pipeline. ABCL 635, ABCL 575, earlier programs.
Makes sense, given the strategy shift.
Then continuing to invest in the platform and infrastructure, the GMP facility, new HQ. They've already put over $600 million into that.
Wow, big bets.
Big bets. They're being more selective on new partnerships, but still open to strategic ones, like that AbbVie-TCE deal.
And crucially, maintaining liquidity.
Yes, maintaining that cash cushion is a key priority. Historically, they used acquisitions like Triani and Lineage. And as expected for a growth biotech, no dividends, no buybacks, reinvesting everything.
So the big question is, are they allocating that capital effectively?
That's the billion-dollar question, almost literally. Their return on invested capital, ROIC, it's negative right now, which makes sense given the huge investments not yet generating returns post-COVID.
So it all comes down to execution, picking the right drug targets, running trials well.
Exactly. Management's ability to pick winners based on science, unmet need, differentiation, development path, and then execute clinically. That's what will determine if this capital creates value or just gets burned through.
The cash runway gives them time.
It does. But they need discipline. Strategic, disciplined allocation is paramount.
Okay, we've hit the business, the management, the strategy. Let's dive into the numbers themselves. Financial health.
Right. And the income statement, as we touched on, really tells that story of two different eras.
Yeah, the revenue surge from 2020 to 2022, driven almost entirely by COVID royalties.
Huge numbers then, but post-EUA revocation, that revenue just evaporated.
Down to $4.2 million in Q1 2025, mostly research fees. A massive drop.
It really is. And while revenue was high then fell off a cliff, R&D spending has just kept climbing.
Which you'd expect, right? Investing in the platform, now the internal pipeline.
Exactly. $42.5 million in R&D in Q1 25. S&M and G&A costs are more stable, maybe down slightly, but the bottom line.
Profitability took a huge hit.
Went from substantial profits during the royalty peak to significant net losses. Q1 25 loss was $45.6 million, or 15 cents a share. Operating margins deeply negative.
Any offset.
Well, they are earning interest income on all that cash and marketable securities they hold, so that helps cushion the blow a little bit on the income statement.
Okay, income statement looks rough post-COVID. But the balance sheet?
The balance sheet tells a much, much stronger story, at least for now. Total assets as of March 31st, 2025, $1.34 billion. Healthy.
Gotcha.
Biggest chunks, $605 million in cash, equivalents, and marketable securities. Huge amount. Then $347 million in property and equipment, that's the facilities, plus about $89 million in goodwill and intangibles from acquisitions.
And liabilities?
Relatively low. Estimated around $300 million. Very little traditional debt.
Which means?
Strong stockholders' equity. Around $1.04 billion.
And liquidity, you mentioned that earlier.
Exceptionally strong. Current ratio around 9.8, very high. Total available liquidity, including cash, securities, some government funding, was about $810 million at the end of March 2025.
So a massive financial cushion, plenty of runway to fund operations for a while, even with losses.
Absolutely. Significant flexibility. But that cash is definitely a cushion that's being used up, right? Which leads to the cash flow question.
Right. How fast are they burning through it? Let's look at the cash flow statement.
Okay. Operating cash flow, OCF, positive back in 2022, but significantly negative in 2023 and 2024. That's the lost royalties plus the high R&D spend rating.
Investing cash flow.
Also consistently negative. That's the CapEx for the GMP facility, the HQ, managing marketable securities.
Financing cash flow.
Minimal, not much activity there.
So putting it together, free cash flow.
Deeply negative in 2023 and 2024 highlights a significant cash burn rate. While they have that big pile of cash now, this trend has to reverse for long-term sustainability. They need to get to positive cash flow eventually.
Makes sense. And the key ratios probably reflect this picture.
They do. Profitability metrics, net margin, ROE, ROA, ROIC, all negative. No surprise there.
But liquidity.
Very strong. Current and quick ratios are high, over 9. Solvency looks good too. Low debt to equity.
Efficiency.
R&D as a percentage of revenue is sky high, which is expected for a biotech at this stage. Asset turnover is low. Those big assets aren't generating much revenue yet.
And no dividends or buybacks, just reinvesting.
Correct. Classic growth-focused biotech approach.
Okay. That covers the financials pretty thoroughly. We understand the business, the management, the numbers. Now, how is the market actually viewing all this? What's the sentiment out there?
Yeah, market sentiment seems, well, mixed is probably an understatement. Cautiously optimistic maybe overall, but with huge disagreements.
How so?
Well, before the Q1 25 earnings, analyst ratings were mostly buy or strong buy. Maybe a bit less coverage since then, but look at the price targets.
It's over the place.
Completely. From lows of $4 or $5 up to $28, the average is around $11.70, $12 maybe. That huge spread just shows how uncertain analysts are.
Valuation really depends on pipeline success, future deals.
Exactly. It's hard to model right now. Interestingly, some automated sentiment tools are leaning more neutral or even sell, pointing to the financial challenges despite the strong cash position. It just screams high uncertainty.
What about short sellers and options traders? Are they betting heavily one way or the other?
The short sellers are definitely active. Short interest is significant, about 23.8 million shares shorted mid-April 25. That's around, what, 11.7% of the float?
That's quite high. Indicates skepticism.
Yeah, and it's been trending up. Lots of off-exchange short volume, too, so consistent pressure.
And the options market?
That's a bit more mixed. The put-call ratio is low, more calls than puts outstanding.
So more bets on the price going up.
Could be speculative bullish bets, could be short sellers hedging, could just mean less demand for downside protection.
Yeah.
Hard to say for sure, but what is clear is implied volatility.
High.
Extremely high, around 129%. The market is expecting big price swings, reflects those polarized views.
So high short interest, high implied volatility. Sounds like a recipe for potential fireworks.
Could be. The market is clearly wrestling with this one. Like a coiled spring, maybe.
Okay, interesting sentiment picture. Let's shift to who actually owns the company. Ownership structure.
Right. And a
So-
key feature here is high insider ownership. As of early April 25, insiders held about 28.9%. That's a lot.
Mostly CEO Hansen.
He's the biggest chunk, yeah, that 19-21% via Zermopoly. But other execs like the CTO and CFO hold meaningful stakes too.
Which generally suggests strong alignment with shareholders.
That's the typical interpretation, yes. Management's interests are financially aligned.
What about the big institutions? Pension funds, mutual funds?
Also, significant holders, estimated 42% or maybe even higher, and some big reputable names in there.
Like who?
Baker Bros is a major holder, around 9.2%. Bailey Gifford, Voya, Capital World Investors actually took a new position recently. OrbiMed, BlackRock.
So sophisticated long-term investors see something they like.
Their presence can often be seen as a vote of confidence in the long-term potential, yes. The rest is the public float.
And we mentioned the recent insider buying back in March. Director Montalbano and Hansen's holding company.
Yep. Adds to that picture of insider confidence, potentially.
Okay, ownership seems pretty concentrated among insiders and institutions. Now, the really crucial part for any potential investment, the risks. Let's do a SWOT analysis focusing on the risks.
Right. We can break them down into company-specific risks and broader industry market risks.
Let's start with company-specific ones. What could go wrong just within AbCellera?
Top of the list has to be financial risk. Those ongoing net losses, the negative operating cash flow now that the COVID money's gone.
Risk of running out of cash eventually.
If they can't generate new revenue, yes, that strong cash reserve gets depleted over time. Plus, future milestone and royalty payments are just inherently uncertain.
Okay, financial risk, what else?
Execution risk.
Yeah.
This whole pivot to being a clinical stage biotech is complex. Huge risk of failure in clinical trials for ABCL 635, ABCL 575, their own drugs.
They still rely on partners too.
They do. Dependent on partner success for those programs and challenges in just scaling up their own GMP manufacturing. That's not trivial.
Any other company-specific risks?
Maybe concentration risk. They were heavily reliant on Lilly before. Success with one big future partner or program could create similar concentration down the line.
Okay, makes sense. Now, what about the wider industry and market risks? Things outside their direct control.
Competition is fierce in biotech. They're up against huge CROs, other specialized platform companies, and big pharma's internal R&D.
Competitors could develop better tech.
Absolutely. Or just find better drugs. There's also direct competition for their lead candidates, other companies working on NK3R antagonists or OX40L antagonists.
Regulatory risk must be huge, too.
Always is in this sector. Getting drugs approved by the FDA and others is long, costly, uncertain, no guarantees. Plus, changes in regulations, healthcare policy, drug pricing, all potential headwinds.
And the technology itself. Could it become obsolete?
Technological risk, definitely. Biotech moves fast. Their platform could be leapfrogged, requires constant, heavy R&D investment just to keep up.
Okay, and there's this new wrinkle, those U.S. tariffs from 2025. How could they impact a Canadian company like AbCellera?
Yeah, that adds another layer of uncertainty. Direct impact could be higher costs for equipment or materials they import from the U.S. or China.
But also indirect effects.
Potentially more significant, yeah. If their U.S.-based partners face higher costs for things like APIs from China, it could squeeze their R&D budgets.
Leading to delays for AbCellera's milestones or royalties?
Exactly. Could delay programs. You might also see broader supply chain disruptions, longer term, maybe even a shift favoring purely domestic U.S. R&D, which could impact cross-border players like AbCellera.
Okay. Any other major risks?
Intellectual property is always a minefield. Securing patents, enforcing them, avoiding infringement claims, ensuring freedom to operate for their discoveries, especially in crowded areas.
Even with the Triani mouse patent?
Yeah, IP litigation is just a constant risk in biotech. So, summing up the risks: financial burn, execution on the pivot trials, concentration, intense competition, regulatory hurdles, tech obsolescence, tariff impacts, and IP battles. Quite a list.
Definitely a lot to consider there. Before we wrap up with a final verdict, just a quick reminder. If you find this deep dive useful, please do subscribe to the Stock Analytics AI YouTube channel. We do these analyses regularly.
Good point.
Okay, so let's bring it all home. We've looked at this company with innovative tech, a strong balance sheet, but also facing huge execution risks and financial headwinds. Back to the original question. Value opportunity or falling knife?
It really is a complex picture, isn't it? On the one hand, you can see some classic value investing appeal.
Like what?
Well, the core business, antibody discovery, is understandable conceptually, even if technically complex. Management, led by the founder with a big stake, seems aligned.
And the price.
And the price relative to assets market cap below liquidity, low price to book, it definitely looks cheap on paper.
But there's always a but.
But yeah, they fall short on other key value criteria right now. Predictable earnings. Not even close at this stage.
The COVID royalty loss really highlighted that.
It did. The path back to sustainable profit is unclear. And while the tech is promising, do they have a truly durable economic moat in this super competitive field? That's still unproven.
So the margin of safety really rests on.
Primarily on that strong balance sheet, the liquidity exceeding market cap, the low PB. That's the asset-based cushion.
But it's eroding.
It is. That cash burn is eating into the margin of safety over time. So it all hinges on whether management can deploy that capital effectively to create future value before the cushion runs too thin.
Okay, so bottom line, from a value investing perspective, what's the final take?
Considering everything, the assets, the potential, but also the huge risks and the losses, I'd classify AbCellera as a speculative buy.
Speculative buy. Okay, for who?
For value investors with a very high risk tolerance and a genuinely long-term horizon, you have to believe the market is significantly undervaluing the assets and future potential.
And you need faith in management's execution.
A lot of faith in their capital allocation and their ability to navigate the strategic pivot successfully. It's definitely not for investors looking for proven profits or lower risk.
So if someone does invest, they need to watch things closely.
Absolutely. Monitor clinical trial progress, watch that cash burn rate like a hawk, keep an eye on partnership developments. Diligence is key here.
Fascinating analysis. A complex story indeed. Okay, that wraps up our deep dive on AbCellera. Now, for that end hook reveal we promised,
Oh, yes.
we're actually planning a future deep dive where we'll compare AbCellera's core technology platform head-to-head with one of its key competitors, like Adimab, for example. We'll base it on publicly available science, patent filings, that sort of thing.
Should be interesting, a direct tech comparison.
Yeah, but we're curious what other competitors would you, the listener, be interested in seeing us analyze against AbCellera in a future deep dive? Let us know down in the comments.
Good question.
And one last reminder, for more deep dives like this one, please subscribe to the Stock Analytics AI YouTube channel.
Please do.
Finally, the important disclaimer. Remember, this analysis is based on information available as of May 8, 2025. Investing involves inherent uncertainties, and things can change fast.
Very true.
This is absolutely not financial advice. And please be aware that AI tools may have been used in compiling and analyzing some of the data discussed today.
Thanks for joining us on the deep dive.